各位来宾，大家晚安。我是柏瑞投信投资长 Steven， 那很高兴今天有这个机会能够跟各位分享一下柏瑞投信对于2023年的整个的总体经济跟投资展望。那刚刚主持人有提到，去年的确是一个非常令大家投资失望的一年啊。去年是什么样的情况？股债汇三杀的一个情况。今年现在是第2个礼拜在就第1个礼拜的情况看起来是什么？股债汇3个都小涨的一个情况那上个礼拜5，美国公布的非农就业数据，看起来不错，而且整个工资上扬的这个风险看起来有稍微下降的一个压力的情况所以让整个市场大涨阴影。那这样子的情况会不会延续下去？我们今年应该用什么样的心态来面对这个不确定的总体经济跟金融市场？那待会也会跟各位分享一下我们柏瑞投信对于今年的一个总体的一个看法首先，刚刚主持人提到，我们今年要用不同的思维来看现在的总体经济跟金融市场。为什么？过去1、2年我们面临到什么样的时代？通膨大幅的上升，各国的央行快速的升息，我们从一个零利率的一个时代，从一个低利率的时代，现在面对的是一个高利率的一个环境。在过去1、2年，很多国家都是负利率的一个情况。大家记得，在2年前，全球的负利率债券，这个是大家最常讨论的议题，有多少？规模有多少？大家还记得吗？2年前，这个规模负利率债券的规模最高来到超过18兆美元，18兆美元。大家知道现在这个规模剩下多少吗？剩下2000亿美元。也就是说，这个规模已经剩下不到10%，剩下5%不到。也就是说，各国的整个利率水准都已经回到一个比较正常的一个情况。现在只剩下日本的公债，短于1年期的公债，才是负利率的。因为现在连日本2年期、5年、10年、30年，全部都变成正的一个报酬了。所以，这会是我们面临到最大的一个不一样的一个环境，就是我们现在面临的环境已经摆脱过去几年低利率的一个环境，我们要重新用一个利率回到一个正常水准来看待这样子一个金融市场。第2点，我们今天要面对的一个是什么样的总体经济成长率？疫情之后，整个经济是呈现一个 V 型反转往上走的一个情况。但是到了去年，我们有迎来了高通膨，迎来了乌俄战争，迎来了央行快速的升息，结果现在经济增长率是开始往下走。以 IMF 的预估来看的话，去年的经济增长率大概是在3.2%，但是如果看到今年大概只剩下2.7%，也就是说今年的一个增长力道会相对比较弱一些，甚至很多分析师也都预估，很多区域可能会出现经济衰退的风险。IMF 也讲了，可能有1/3的经济体今年可能会出现经济衰退的一个情况。那我们预估今年的整个总体经济环境呢，大概会呈现一个先蹲后跳的一个格局。但是能不能跳得很高？今年是兔年，能不能跳很高？看起来也只是小小跳一下我们希望不要陷入到严重衰退的一个情况。那第3点，我们要面临的就是我们认为固定收益的投资今年会重回大家的一个投资的主轴过去2年，大家如果有买债券、买固定收益的商品，一定是非常的辛苦因为刚刚朱总也提到了，过去40年、50年没有看过利率这么快速上扬的一个情况但是我们还是经历过了走过了这样子辛苦的2022年，进入到2023年，我们面临的是什么？经济增长比较疲弱央行升息到了末端，通膨我们也看到开始陆续的缓缓的往下滑落，所以呢，固定收益的投资将会重回 我们的一个投资的一个主流，这是我们今年绝对不可忽视的一点。那最后一项呢，就是这是一个未来一直到2050都不会退潮流的，叫做 ESG 不管是 ESG 也好，或是我们现在非常关心的减碳啊，对气候风险这样子的一个主题，这样子的一个投资都会是在未来数十年都可能会持续引领热潮的一个主题哦。那首先我们先来看一下现在的一个经济情况到底是怎么样，我们还是从美国来看起。我们可以看到呢，就美国的市场最新的联准会的一个经济的一个预测还是看到就是说它的这个终端的利率应该会升到5% 到5.1左右的一个水准，但是我们可以看到2023年就会是升息的最高点那到2024、2025整个预期的都是呈现一个往下走的一个降息的一个趋势那你如果看它在12月的最新的联准会的会议记录里面，可以看到它对于接下来的一个不管是通膨或者是经济增长的一个预测，第一个主要的调整相较于9月就是经济成长往下修，通膨往上修，失业率往上修。这个意思是什么？联准会它将请它的权力去打击通货膨胀，就算会造成失业，就算会造成经济成长的下滑，但是他觉得现在最重要的目标还是去控制通货膨胀，所以这就是过去1年他所做的事情。为什么他要每次升3码、升2码这么快速的累积升息的幅度？那现在呢？现在当它升息到了接近这个水准，我们预期今年的2月升一次，3月升一次，接下来它就要进入观察期观察什么？累积这么多的升息之后，对于总体经济的影响，对于通膨的影响，是不是如联准会的一个预期那过度的升息会不会对经济跟就业市场带来严重的冲击？这都是要进入到开始看这样子的一个货币政策的一个效应的一个阶段所以呢，对于总体经济的一个展望来看的话，我们看一下以全球的采购经理的指数来看的话，这个包括了制造业跟服务业的一个指数，你可以看到在左图的部分，几乎大部分的指数分项指数包括产出也好包括新订单也好，几乎都在50以下。像我们最近跟很多这个上市柜公司我们去拜访事实上大家对于订单的能见度都相对比较低，而且从去年第4季开始的去库存的压力还是非常的大所以今年上半年我们还是看不到很漂亮的一个前景，尤其在订单的一个部分。但是我们看到另外一个亮点叫做什么？就业。我们可以看到在橘色线的一个部分就业的指数一直撑在50以上的一个水准。大家也都知道，美国的就业市场目前还是非常的一个火热那就业将会是我们认为经济不至于陷入到大幅衰退的一个主要的原因那另外我们再来看，就是说通货膨胀是另外一个大家非常关心的一个议题，因为即使到最近公布的最新的一个数据，美国的通货膨胀还是在7% 左右，那以欧洲的通货膨胀，事实上 CPI 还在9点多的一个情况。但是我们看到了一个趋势，因为我们做投资看经济数据，最重要是看它的一个趋势的一个变化。虽然通货膨胀数据还是很高，我们可以看到右侧这一张图，这个叫做通膨惊奇指数。什么叫通膨惊奇指数？也就是说，这个数值如果是在0轴以下的话，就是代表公布的通货膨胀比预期的来得低那如果这个数值是在0轴以上，就是代表公布的通货膨胀比预期的来得高。我们看到最新的数字是什么？通货膨胀开始连续几个月都是低于预期那我们也知道，其实以美国的通货膨胀来讲，最高的数据出现在几月？6月虽然它有做一个 M 头啦8月又弹上来，但是高点几乎就是出现在6月份 开始一路往下走，虽然还没有走得很快，还没有下滑得非常快。欧元区的一个通货膨胀的高点发生在11月的数据，然后之后开始稍微往下走。所以我们会认为就是说，以通货膨胀最严重的时间点已经过去了，美国在6月，欧洲在11月，现在我们已经进入到2023年的一个1月份，所以通膨的缓解，跟就业市场的一个稳定，是我们认为经济跟接下来的一个固定收益市场会是很好的一个发展的一个投资环境哦。那美国的就业市场到底有多强？我们从左边这一张图可以看到，就是说这个图显现出来是美国现在的职缺跟找工作的人，它的中间的一个差距。大家知道现在美国有多少工作找不到人吗？现在有1000万个职缺，美国有1000万个职缺找不到人，那你说工资会不会往上涨？这个就是美国的就业市场会这么火热的一个主要原因。第二个，大家知道，现在已经疫情过了3年了，跟疫情前的劳动市场相比，美国的劳动力少了350万人，350万人跟疫情前相比，这些人不是因为染疫走掉了，这可能有一部分，但是大部分的是因为疫情的关系。我可能提前退休啦，或者是我在过去几年因为房市大好，因为美国的房市在过去几年表现得很不错嘛，房市大好，股票大涨，我存了一些钱，我就可以先不工作，或者是因为我要照顾家里的老人啊、小朋友啊，因为疫情不能去上课上班，那我在退休在家里面照顾这些人，所以美国的劳动力也少了350万人。所以你可以看到职缺这么多，劳动力少了这么的多，所以美国的就业市场还是维持着一个非常火热的一个情况。大家有工作，大家有钱赚，工资还可以往上走。你说美国的消费力道能够弱到哪里去？美国经济会不会衰退？我们看到制造业的确走弱了，我们看到零售销售的确也不是很强，但是在就业市场还是比较稳定的状况之下，美国要陷入大幅度的衰退，这个风险是相对是比较低的。那不过也有投资朋友就讲啊，那工资这么高，会不会造成通货膨胀下不来？的确，工资的持续往上走是造成通货膨胀降不下来的一个主要的原因之一哦。但是我们看从右边这张图的一个蓝色线可以看得到。美国工资的领先指标的调查指数啊，也就是他调查这些企业，未来还会不会持续加工资，会不会加的比前一次还要多？这个调查已经慢慢的往下走，也就是说，美国劳动市场最紧张的时刻也已经过去了，现在是呈现一个比较舒缓的一个现象。大家也看到，最近很多大企业都在做什么？裁员今天高盛裁了几千人，之前包括亚马逊包括 Meta 脸书，事实上他们都裁了不少的人但是对于我们刚刚说的1000万的缺口，其实还是有一大段的一个差距的。所以这也是我们认为美国的经济虽然可能会陷入到一个增长不振的一个情况，但是还不至于陷入到一个衰退的一个风险。那我们来看一下第二大的一个经济体就是在欧元区的一个部分。那整个欧元区的话，我们可以看到它整个这个不管是 PMI 的制造业也好，或是服务业也好，它的指数目前也都是站在50以下的水准。但是你可以看到什么？最新的数字在12月竟然，欧洲竟然有稍微往上涨了一点点，虽然还是在50以下。之前我们都觉得欧洲很惨，为什么惨？因为乌俄战争他们是首当其冲。因为能源价格的飙升，他们也是首当其冲。我们可以从右侧这张图可以看到，上面包括蓝色线跟红色线是欧洲的天然气的价格，下面淡灰色的那个叫做美国的天然气价格。你们有没有发现差在哪里？美国的没什么涨嘛，美国天然气没什么涨嘛，因为他们自己是一个最大的生产商那他们供需其实是供过于求的。 但是在欧洲，因为大幅仰赖俄罗斯的一个天然气，所以俄罗斯一停工，整个天然气是飙升了数倍的一个情况。那当然，对于欧洲的通货膨胀或是能源价格，也带来一定的一个很大的一个影响。但是我们看到最近发生什么事情？现在油价剩下多少？剩下70几块，对不对？那现在天然气的价格已经回到了战争前的一个水准，甚至比战争前还要来得更低。很多原物料价格，包括很多农作物、玉米、小麦等等，这些都回到了战争前的一个水准。所以呢，过去1年累积的这些原物料价格造成的通货膨胀，对于欧洲的影响开始在呈现递减的一个状况。那再加上欧洲的这些政府也开始要去做补贴，去援救他们这一些消费者，包括对于他们的能源价格去做补贴，包括对财政政策上面来做一些刺激的一个方案。所以欧洲呢，虽然经济看起来还是在全球里面相对是比较疲弱的一个经济体，但是呢，我们认为就是说应该还不至于像我们可能在几个月前预测的，可能会陷入到一个比较严重衰退的一个风险。好，下一个我们来看一下日本。日本最近我不知道大家有没有去日本玩日元突然就涨了上来嘛，对不对？日本公布了它要把所谓的这个目标的利率区间把它放大，这会有什么影响？会不会造成日元大涨啦？会不会造成资金从头回去到日本的一个情况？因为过去日本是负利率的时代，钱拼命的往外投资，那很多投资人会担心，钱会不会是因为这样子而回流日本，而造成很大的一个金融市场的动荡？那首先我们来看一下，其实以日本来看的话，就现在的日本的公债殖利率大概已经接近在10年期，大概是在0.4到0.5% 左右。美国的公债殖利率多少？10年期3.5到4%。可是你知道，如果日本人去买一个美国公债，然后避险成回来日元，剩下多少？你知道吗？变成负的报酬。因为现在美国跟日本的利差太大了，所以避险它要避掉5%。所以你如果是一个日本人，日本投资人，他去买了美国的公债做避险之后，他剩下负1%的报酬，不划算。买欧债也有类似的一个情况。所以的确，我们从右边这张图就可以看到，事实上在2021年，我们就已经看到日本投资人在慢慢的降低他们的美债的持有。所以事实上不是最近日本央行公布了，他们才做这个动作。事实上，在过去1年多2年的时间，他们都已经开始在逐步降低这个美债的一个持有。但是买美国公债利率不够高，还是负的。但是如果买投资等级债呢？如果是买非投资等级债呢？事实上，这样子的避险完后的收益率，还是会是比他们的日本的公债殖利率还要来得高。所以现在日本投资人可能开始会转向去看投资等级债或是非投资等级债的一个部分。所以我们认为，就是说，日本央行这个动作应该只是给予他自己未来比较大的弹性，但是货币政策的转向还不见得尤其日本现在想要达到2% 的通膨，这个几率还是非常非常的低所以在日本的这个部分，我们还是要继续观察它长期的货币政策会不会做什么调整。但是在今年，我们看不到很明显的一个转向。那最后我们来看一下中国，中国应该是最近大家比较关心的一个议题因为从去年第4季开始，它的20大之后，20大本来大家看起来好像是一个中央集权的一个倾向比较高，大家可能对于一些刺激经济的政策几乎都没有谈到。事实上，市场是比较失望的反应。但是没想到过了多久，过不了多久，结果他们开始推出了很多房地产的刺激方案开始救援在过去2年借不到钱，然后又要收归国有然后破产的这一些房地产的一个公司，让他们可以借得到钱，甚至到 H 股去做挂牌增资的一个动作那接下来在中央工作经济会议，我们又看到他开始推出了什么？ 开始重新定调中国要走向稳经济的一个路线稳经济去支撑现在的过去相对比较疲弱的一个经济增长。那更重要的是，就在最近，他们的动态清理虽然没有明讲，但是终于已经做了一个反转的一个动作虽然造成这个感染率快速的上扬但是现在大家非常期待，就是说接下来他们可能能够创造的消费也好，旅游也好，甚至是进出口的一个支撑也好，甚至之前相对比较疲弱的房地产的一个市场，对于原物料、对于基本金属、对于建材的这一些的一个需求，都渴望有一些回升所以中国虽然还是不确定性还是蛮高的，因为政策的风险，因为政治的风险还是比较高，但是我们也觉得最坏的时刻看起来似乎已经过去了。那在这样子一个经济环境之下，我们可以看到整个经济增长相对比较疲弱一些那整个货币政策也来到了一个相对高点，可能第一季成熟国家就是来到了一个高点，但是你要看到央行快速的降息，这个几率相对是比较低的，所以我们可能会在低成长、高利率的环境之下维持蛮长的一段时间。那在这个状况之下呢，最好的投资我们就需要回来看固定收益的市场。为什么？我们从左边这张图可以看到，现在美国公债殖利率大概3.5到4%，投资等级债在5% 以上的这样报酬率。你看非投资等级债，几乎是8%，甚至到接近10% 这样子的一个报酬。我们就看展望未来1年，假设整个市场是上上下下震荡整理，你做股票投资，大家都喜欢，大家都觉得我能够抓到最低点，卖在最高点。可是大部分的投资人大部分都是追高杀低比较多啦所以今年做股票投资其实是还相对是比较有一定的难度你要抓到高低点，可能来来回回是一场空。但是固定收益，你可以看到我们的利息收入现在都是非常的吸引人。就算今年是一个平盘整理的一个状况，我们的固定收益的利息收入都能够提供给投资人一个非常好的抗震的一个选择。那当然，我们还可以在今年的一个各种的不同的经济环境之下去寻找赚取资本利得的一个空间所以这也是我们认为固定收益为什么会成为大家今年投资必须一定要有的这个资产类别所以总的来说，我们大概把今天刚刚跟各位报告的分享内容大概再整理一下。第一个，我们认为全球的经济增长应该会呈现先蹲后跳，但是跳不太高的一个情况那因此在这个情况之下，我们看到通货膨胀的高点应该都已经出现了，尤其是成熟国家。但是你要看到成熟国家的央行快速的降息不太容易，但是今年应该会是从升息到停止升息的阶段，那到了第4季不排除开始会有央行做降息的动作。但是新兴市场的央行今年上半年你就会看到新兴市场的央行做降息的动作所以在这样的一个情况之下呢，我们认为固定收益将会是今年2023年的一个投资的一个主轴。因为经济前景不明朗，因为企业的获利还在下修，还在去库存，还在做往下调盈余预测的一个阶段。所以呢，固定收益呢，我们就首选投资等级的一个标的，信用体质无虞，收益率又高。但是我们又看到，在非投资等级债里面，收益率非常的吸引人。但是你要在这么高的收益率里面，它当然会有相对比较高的信用风险。所以透过主动的选债，挑选好的、质优的这样子的个别的标的，会是在非投资等级债今年胜出的一个关键当然还是有投资人可能会想要问一下股票，刚刚祝华也有提到整个今年的台股的波动去年台股的波动也是非常的大，今年怎么看？我们认为今年的股票市场呢，的确是相对是比较难操作。 今年你要看到大行情不太容易，但是你要掌握住对的趋势，尤其是政策支持的这些方向。像我们刚刚提到的跟 ESG 跟减碳相关的题材，可能会是今年在股票市场会比较有表现空间的一些题材。那以上是我今天对于整个总体经济跟投资的一个展望，跟各位分享，谢谢。
Well, it's certainly great to be back in Taiwan and Taipei. I think there's a lot of people, and I have not seen as many people as this since lockdown started. So great to be back. I'm going to be presenting the outlook for preferred securities. But first, I'm going to really rewind a little bit and tell you about what happened in this difficult period, I think, for all of us. And financial markets were quite difficult to navigate. First, we had the lockdown. As a result, the central banks globally, as well as fiscal stimulus appeared, and there was a lot of monetary and fiscal support. But now, what happened in 2022 was quite unprecedented. Because Fed really overstayed their welcome, and they felt behind the curve in withdrawing the monetary stimulus and not stopping the quantitative easing. So as a result, they had to catch up, and they had to raise short-term rates by more than 4%. As you can see in this chart, that resulted in the whole curve shifting up, and in unprecedented move, definitely the first time in my career, I've seen 10-year rates increase by more than 250 basis points, and 30 rates by a similar amount, around 200. Really, we have not experienced anything like that in probably since the 70s. And I think this what really drove the performance of all of the asset classes globally, because US and the Federal Reserve US is still the largest economy, and clearly Federal Reserve is the most powerful central bank out there. So everything from equity market, currencies, commodities, everything is really keyed off of the federal funds rate. Obviously that happened already. The good thing is I was not presenting this outlook last year because the yields on preferred securities, as well as most of this fixed income, was really depressed based on that Fed funds rate. Now what happened as a result of this move, for the first time since 2009, the real rate are finally positive. And they're not only positive, they're really positive from the second, from 2 years on, so 2-year, 5-year, and 10, and 30, and so on and so forth. So that hasn't happened since 2009, since global financial crisis. Why is it important? Well, finally, after all these years, fixed income investors are getting paid to take interest rate risk or taking duration risk. So you have a positive return when you're giving money to someone, which is, as a portfolio manager, as a fixed income portfolio manager, this is a great time to be in fixed income. And I'm not just talking about, the portfolios that I manage, but it's really investment grade fixed income, high yield. You'll have John talking about high yield later. Any type of fixed income is really, really attractive. And again, that hasn't happened in a long time. You would probably ask me, well, what's going on with Fed funds rate and inflation? And by the way, when I say real rates, I'm talking about the difference between nominal rates and investors' expectations of what's going to happen in inflation in 2, 5, and so on and so forth years. The short-term rate is still negative from a real rate perspective. So what we're going to be experiencing, and I think a lot of people are talking about, is whether Fed is going to continue raising rates to go above the inflation, short-term inflation, or the inflation is going to come down by itself. It still remains to be seen what is going to happen, but in principle, in an environment like this, you already want to take duration risk. Therefore, for instance, in our portfolios, we prefer taking duration risk relative to credit risk or spread duration risk. So it's really good time to take duration risk. I also would like to point out that these real positive rates don't stay for too long. And why is that? Is as these rates go through the economy and the economy slows down, clearly this real rate is not sustainable in highly levered economy. So as a result, you're going to expect these real rates actually come down. And we actually have seen that in the beginning of this year already, where the long end of the curve started coming down relative to the short-term rates, which is now the whole curve is inverted. Next page, I'm going to talk a little bit about the valuation of preferreds. And I think they look fairly valued at the spread levels where they are. We usually, when we talk about valuations, we really talk about spread of our securities relative to treasuries or relative to investment-grade credit, because these securities are issued by investment-grade companies, which are really concentrated in the financial sector. Which brings me to this big spike here in 2009. Since all of these securities come from financial sector, clearly they didn't perform really well in 2009. And that is really an outlier along, together with probably 2011 to 2012, where that financial crisis was also present in Europe. And then you can see the last spike is COVID. So only 3 times on this really long-term chart, the spreads were actually higher. So we think, given the outlook for US economy, we think the preferred securities on valuation basis are fairly valued, given that there's probably going to be a slowdown of US and global economy. Again, it still remains to be seen whether we're going to avoid hard landing or we're going to just experience a soft landing. Putting on this page, there's a concept in preferred securities. They're not as straightforward as, let's say, bullet bonds. They have what we call convexity. So when the issuer issues the security, investors get paid more money, but the issuer can call the security from the investor after 5 years. So when rates are going down, usually the issuers would not call these securities, but when interest rates go up, as they did in 2022, issuer doesn't call the security, and therefore most of the time they're going to drop in value and trade below par. Since we already went through this interest rate rising environment, that profile of the whole preferred market shifted, so there is less risk in our asset class, which is, from my perspective, it's a very hard risk to manage. So now I don't need to worry about it as much and therefore, not only you took the risk out, the rates went up, valuations look attractive. You can put it all together on the next slide, and we'll look at what we call yield to worst. Again, looking back, we haven't been here since 2009. Keep going to 2009. Really, the all-in yield right now on prefs is around 7%. Really, again, I think since we actually launched this fund, and I first time came to Taiwan, we didn't have this kind of yields before. So really, really good timing, I guess, for reopening and me getting these new shoes and coming here. But we keep talking about yields as they relate to our own asset class. How do we compare it to other fixed income asset classes? As you can see, European preferreds yield very high double-digit returns, but that is as of November. Right now, we're looking at around 8.5% to 9%. As a matter of fact, I was buying a new issue yesterday while I was here, which yields 8.5%. So very, very attractive yield levels in Europe. And U.S. counterparts as well. They yield right now around 6.5%. More importantly, not only we have good yields in our market, but also the market itself is quite large. So in the last, I would say, 8-9 years, we grew to 900 billion in notional amount of securities, which allows us to really build portfolios that are going to perform in all different environments and will perform very well in different scenarios. I would contrast that, for instance, to a typical ETF, where ETF would hold all of the securities. For instance, an issuer like JP Morgan would have 12 securities in their capital stack, which have all different characteristics. As a manager, I can just pick one that I really think is going to perform better in all different scenarios. And that's why I think in the case of something like preferred securities, you really would like to go with an actual active manager as opposed to an ETF that would just buy all the 12 and weight them pretty much equally, which would not really have protected you, for instance, in the 2022 last year. I keep talking about yields, but what about risk? Obviously, these yields come with a fair amount of risk. If you could get 7-8% without risk, that would be a great world, or maybe not, I don't know. But in terms of risk profile, here I highlight risk-adjusted returns of the different asset classes in fixed income world. The green points are preferred securities in the United States as well as Europe. As you can see on a risk-adjusted basis, they deliver Sharpe ratio 1. And usually when I think about Sharpe ratios, everything that's 1 is really, really attractive to investors. It should be really attractive. And if you have, for instance, any other asset classes in fixed income already in your portfolios, preferreds are, they're correlated, but they're not 100% correlated to any of these. I think the highest correlation is probably to investment-grade credit, which is, at the end of the day, it should be correlated because the issuers are investment-grade credit companies. Even that correlation is 0.7. So if you add preferreds to your portfolio, your efficient frontier would shift left and up, and not only you're diversifying, but you're also diversifying and achieving higher yields. As I showed in the previous slide, these securities do yield even higher than some of the dots on this chart. Another point to make is in 2014, the regulators decided we're not going to allow another 2008 to happen. Therefore, they introduced new regulations in the United States, Dodd-Frank, and Basel III Accord globally. As a result of that, the structure of these securities and what they do changed. So we really show this chart from 2014. Well, guess what? In 2014, when these securities came to market, they actually yielded something like 7-8%. So we're exactly in the same place as at the inception in 2014. The only difference is this chart already includes a big drawdown of last year, which pushed the risk-adjusted returns a little to the right. But you would expect to, at least I expect, that the Sharpe ratios for these securities for the next 5 years are going to be 1 or even higher going forward. Which brings me to our expectations for the year. I keep mentioning that 7% is attractive, and this is really our base case for 2023. I think it's possible that we're going to have a little more because there's going to be new securities that come to market with very attractive features. But really it's a base case that assumes that most of this return is going to come from yield, from carry. Again, since we incepted this fund in Taiwan, we haven't experienced this kind of yields. And then the other scenarios are, even in a down case, you're still getting a little bit of a positive return. And that is, again, based on the idea that usually what happens is as spreads widen on these securities, the treasury component helps you and the treasuries rally. So it's a combination of the two components that really deliver these high adjusted returns, given where the rates are and where the spreads are right now. Again, last year I think it would have been a completely different conversation, but now they really look attractive. Having said that, I think most of the fixed income looks attractive, and John is going to talk about high yield, but I'm going to quickly just mention why, again, if you have high yield, we're not that different from high yield. There are differences, but the two are complementary to each other, and really, sector composition is quite complementary. So as I mentioned before, preferreds come from financial institutions mostly, you cannot really be a successful bank if you're rated high yield. So really the sector composition is complementary, but also the drivers. Preferred securities are going to be more susceptible to overall financial conditions, what the Fed does, and high yield would be more economic driven, which would be really individual sectors, individual companies, and economic outlook. High yield would have higher default rates. We would have less defaults, but also a lot less recovery. So the two are really complementary and can really work in your portfolios together or separately. With that, I think, again, I would like to close and thank you for coming here, and think we're going to have, judging by the amount of people here, I think preferreds are going to do well.
Well, thank you, and I'll echo what Vlad said. It's very good to be back. It's been 3 years since I've last been here. We started the Global High Yield Bond Fund in 2008, and been coming to Taiwan really almost every year for the last 12 years. So it was a little bit of a miss, but good to be back. And I would echo some of the same comments that one of the things about being back is this is the end of a 3-year period for normalization, not just of the pandemic, but of bonds, where we had the reset in Treasury yields last year, and it was painful, but we're basically back to where fixed income makes sense again from a total return perspective. We're at the end of the yield adjustment, and central bank adjustments have mostly taken place, and we'll see that as we go through the market. But really, we'll talk a little bit about the different characteristics of the fixed income asset classes from investment grade all the way through to below investment grade. And basically, you're trading off duration risk or interest rate risk, and you're picking up additional yield and taking spread risk because there's more economic sensitivity in the below investment grade space. And so this is just looking at various fixed income asset classes, really decomposing the characteristics, looking at the volatility, the duration risk, and the yield that you're getting for that risk. And where my portfolios live is over on the far right-hand side, where we're getting relatively higher yields, less duration risk, and getting the highest yields that you really get per unit of volatility. And that's really going to be, I think, critically important as we go forward. We are picking up that extra yield, and now that we're through the adjustment that we've had with interest rates, we are back to a more normal environment and really exiting the extreme quantitative easing since the global financial crisis that got even more extreme with the pandemic. So it's been a rocky ride, certainly for the last 2 to 3 years, but we're exiting that and getting back to a more normal environment where everything just makes more sense again. And just to kind of pick up on that point, last year was a really weird year for a fixed income, generally speaking. And when we see that, basically on this chart, we're looking at the return components for high yield, pulling it apart into the spread return component versus the duration component. And generally, they offset each other. So we've got the current yield that buffers some of the volatility, but in environments where spreads widen, interest rates usually fall and offset some of that, and conversely, in times when spreads are tightening in the asset class, interest rates will offset some of that, and they balance each other. Well, last year was the big outlier, where we saw a little bit of drag on the total return from both the duration component and the spread component. The duration component, because of the adjustment in yields, as we removed the massively accommodative fiscal and monetary policies, and also the move upward in yields, as inflation started to pick up and shifted the curve much higher. That I'm happy to think is mostly normalized and is out, and we are back to a more normal operating environment where we think that you'll see the historic pattern of those two components offsetting each other and buffering each other in different economic environments will persist. So, again, the normalization of the pandemic allows us to travel again, but it's also normalized yields to where these historic relationships we think will come back into play that have existed, really over the course of my career and kind of disappeared over the last 2 years. So, we'll talk a little bit about leaders, laggards, but the other thing to think about, is just with that throughout fixed income, there's different leaders and laggards every year, and they do switch places. It just points out that to be dynamic in your asset class allocations and think less about the returns that persisted over the prior 12 to 24 months and more think about the environment as we go forward. We do think that fixed income is going to be a favorite asset class next year. I think it's going to be, there was really no alternative from a return perspective, away from equities for the last 2 to 3 years. And again, part of the normalization, fixed income is going to be a very attractive substitute for a lot of different asset classes, and it's going to be quite attractive in its own right. So next we're going to talk a little bit more about the underlying fundamentals of the asset class and really get more into expectations as we go forward and how we think that fixed income markets will fit into a portfolio overall. So I'm happy to report the below investment grade credit market, we're really coming into this environment from a position of strength. So while the pandemic was really painful, certainly for companies to go through, in my career, we do a lot of financial modeling and stressing of the companies in our universe, but it never dawned on us to assume that a quarter of our market would have their revenues go to zero for a year or two. And that was basically what the pandemic did and caused us to look at things in a different way. It also really stressed the issuer base to really reconsider capital allocation policy and how they think about running their own businesses, and caused a lot of these companies that survived the pandemic to really reassess how they think about their debt balances. And because of that, you can see on the left-hand side here, we're going into the environment with some of the lowest leverage levels that we typically see. Usually companies during an economic cycle will try to run their balance sheet and as though the cycle is going to last forever, and they'll continue to lever up their balance sheets, and then we'll have an economic downturn, and the most levered companies will potentially have to find creative ways to delever the balance sheet or potentially default, and then the whole cycle starts over again. And that's not what's happened this time, because we've had economic volatility really about every 3 years over the last 10. We obviously had the taper tantrum in the 2011-2013 period, which caused some spread volatility. We had our own issue in the U.S. We were around energy prices in the energy sector, 2015 to 2017. And then, of course, the pandemic caused another bout of volatility. And it really did two things. One, it cleaned out a lot of the companies that just frankly weren't viable. And the other is that the companies that were left just impressed upon them that perhaps it's not a good idea to run a very levered balance sheet throughout an economic cycle. And so debt leverage is really quite low, which I think is a really good indicator about how we think about stress going forward in future default rates. On the other side, you can see, again, the darker line really shows how much the debt levels have come down, just from a percentage basis on average. Companies have really cut the debt on the balance sheet, and you'll see that again on the next slide. But the other on the light blue line, the cash flow generation ability of these companies, they're fully recovered from the pandemic. So I talked about that smaller proportion of the market, and I'm talking mainly travel, leisure, cruise lines, which all came to my market from Fallen Angel Land, as well as specific retail companies and just the variety of businesses that I'm sure you're all familiar with that saw huge disruption from the pandemic. They're all back, and their earnings have all recovered back to 2019 levels. So again, we've went through this 3-year period, and everything is normalized. And for a below investment grade, portfolio manager, it's good news. So the companies are back, their earnings power is back, and their balance sheets, those that survived, are actually in much better shape. So we are entering a period of a little bit slower economic environment because of what central banks are doing from a position we think of strength. And just picking up on that theme, I'll address the average ratings, which I think is really important. The ratings in my world, it is still below investment grade, but the better part of the market, the double B part, continues to grow. So in the U.S. high yield markets, majority of the issuers are double B rated, so the highest ratings category, and that's really good news. We've had a lot of issuers that have originally issued in our market, meaning came to our market specifically as double B issuers. And we've also inherited fallen angels from the investment grade market. And just because they're no longer triple B issuers, they're still double B issuers, and they're considered pretty high quality companies in our world. And that's good news. It's a majority double B market now, which is something that we haven't seen up until the last couple of years. But the other side of that is the CCC issuance, that the really low-rated stuff, the part where we get a lot of the default risk in the market, that's really shrunk, and it's really the smallest that it's been since the late 1990s. So CCC credit has shrunk from being about 18%, right around the financial crisis, to now it's about 10 to 11%. So it's a very small part of the market, which really, I think, is important as we think about potential default risk as we head into a slower economic environment. On the other side, the global credit markets in the below investment grade space, it continues to grow, and it's one of the largest, most liquid credit markets. So it's about $3.5 trillion when we look at US, Europe, and the hard currency emerging market corporate space. It's really grown a lot from the financial crisis times. The financial crisis and the changes in bank regulations really encouraged banks to the big money center banks to push more risk off their balance sheets and into the capital markets, and that's really accounted for a lot of the growth. And then because as the market grew, became larger, became more liquid, it just became a self-perpetuating cycle to where the market continued to grow. And in the last 12 months, you can see the size of that fall a little bit, and that's really the companies voluntarily delevering their balance sheets. So the number of issuers, still the same. We continue to get more companies coming into our market to issue debt, but they've cut their debt balances, and that accounts for a little bit of the decline in the overall outstanding size of the market here recently. So again, debt leverage is extremely low. Our earnings have recovered from the pandemic. Even though it's a large liquid market, we continue to see more double Bs, less triple Cs. So we're really coming into a period of potentially slower economic growth that's been engineered by central banks to remove some of the stimulus from COVID. So even if as we slow, we're coming into this really from a position of strength. Now, I talked a little bit about the lower ratings tier and why is that really important. As we think about moving into an environment where central banks globally are removing accommodation, trying to slow the economy, trying to fight inflation, we really need to be much more cognizant of the default risk that exists in our market. And really thinking about that, investors like to talk about the default rate as though it's one number. And on the left-hand side, you can see where that is over time, but the default rate is really a phenomenon that exists in the lower ratings tier. On the other side, you can see the default rate for the different tiers. So the double B default rate is basically zero. I think it's 20 basis points on average. The single B default rate's really not much different. We get most of our defaults in that triple C ratings tier. And again, we're coming into this from a position of strength where the average credit quality is so much better that the triple Cs, that used to be 18% of our market are now 11% of our market. So, even if we get a pretty large proportion that moves in the triple C space in and of itself, because it's so much smaller, it's really not going to move the needle of the overall default rate of the market a great deal. Defaults in high yield, generally speaking, have moved up from about 0.5% to about 1.5%. We do expect that number is going to move up a little bit more as the economy slows, perhaps to 3-4%, about as high as it can get. That's really accounted for in current pricing, but as you can see, relative to history, it's really difficult for us to envision how we would get any type of spike even in a normal recession, which is not our base case. But the average credit quality is quite good. We're really not that worried about default risk, but we are cognizant that it exists, and we want to think about that in the way that we're positioning our portfolios. The reason we're thinking about that is because even though the economy looks like it's in pretty good shape, it's clearly slowing. The bottom chart really looks at coincident and lagging indicators. So coincident, lagging indicators, things like business inventories and wage pressures. Coincident indicators would be things like the unemployment rate, things that are indicating how the economy is performing in real time. Those indicate that the economy is actually doing pretty well. But the top chart, when we look at the leading indicators, when we look at purchasing managers' indexes and those indicators that really give you, that historically have indicated where the economy is going in the next 6 to 12 months. Those are clearly slowing down. That's not a surprise. Central banks are trying to engineer that slowing on purpose to combat inflation globally. And so it's not a question of is the economy slowing, it's how much is it slowing and how much we need to be concerned about it as we think about our portfolios. Particularly in the below investment grade credit space, we need to be really attuned to this so that we can think about metering risk in the portfolios. We want to maintain an appropriate risk posture, one that's generating the highest current yield that we can for our investors, but not one that's so high that we are taking undue risks and have potential negative experiences from a credit risk perspective. And so that's the way that we're thinking right now. As we look, as we kind of look at where we are, look in the rearview mirror where we've been, the economy looks pretty good. As we look forward, things are slowing, and we just need to be prepared for that, even though we are coming into this from a position of financial strength. And so we think about this, how do we think about the sequencing of an economy as the economy slows down? When we think about, again, that first slide I put up, and we think about the spread duration risk versus the interest rate risk of everything that we buy in our portfolios. The credit, the spread being that yield premium that we're getting over treasuries versus what we think treasuries will do. The two of them being the total yield of our investments. How do we want to think about, those two components as they move through the portfolio? So the first chart shows you what treasury rates do around economic slowdowns. And treasury rates usually top out right as the economy is slowing down, which is probably sometime around now to the next 3 to 4 months. And it indicates historically, treasury rates top out right around, pretty much at the same time that the economy slows down. So even though interest rates were a pretty big drag on returns last year, you're getting paid for taking duration risk at this point, and we're not really concerned about the duration risk component of the portfolio. More so on the other side, really using equities as a proxy, how to think about credit spreads. What should credit spreads do around an economic slowdown? And looking at equities, so this is looking at the S&P 500 with a 6-month lag versus economic slowdowns. Risk assets usually bottom about 6 months after the slowdown starts. So, thinking of this as equities, but we're about 60% correlated with equities in the below investment grade credit space. That indicates that we don't think there's a lot of fundamental risk in the market, but we do think spreads will be range bound. And while we want to make sure that we're getting paid appropriately and that our investors are getting appropriately compensated for the risk in the portfolios, we want to be cognizant that we don't take too much risk, because we might have an opportunity to buy things cheaper later this year as the economy slows. And so it's really balancing those two. So thinking about interest rate risk, that's probably over. The yields have likely peaked here. Spreads, spreads look pretty decent to us right now, but they're probably going to get cheaper before they get richer again. And so it pays us to think about the risk in the portfolio, and then you leave a little bit of a bucket for us to buy things cheaper later while maintaining a yield that's as high as we can get it without taking undue risks right now. Now, I talked earlier about, and Vlad did as well, fixed income is part of a portfolio. What's the return outlook for the asset classes? And not just below investment grade, not just preferreds, but really all asset classes. And this picks up all asset classes, fixed income, equities, alternatives, and we want to look at them holistically. Where are you getting the most return per unit of volatility? So the vertical axis is returns, the horizontal, volatility. And this is put together by an asset allocation team at the firm that interviews all the specialist portfolio managers, myself, Vlad, on all the portfolio managers across the different asset classes. And they use our inputs into a quantitative model to try to figure out the answer to this question. And what's really interesting about the way that this curve looks now versus the way that it looked a couple of years ago is now that yields have reset, the fixed income actually looks pretty good on a Sharpe ratio basis. So really the returns are all bracketed between about 7 and 9%. But as you go shift that out to the left, into the equity asset classes, you're getting pretty similar returns, but at about 2 to 3 times the potential volatility of the investment. To our mind, this favors fixed income over equities. Really up until last year, there was no alternative but equities if you wanted to get returns in a portfolio. But now that we've had the rate reset and where fixed income is relative to equities, fixed income looks like a better value. Certainly as we go into a little bit of a slower economy, where you've got, with equities, you need prices to go up. With fixed income, you're clipping a big coupon, you just need prices not to go down. And this seems like a good environment for that. So fixed income is basically favored over equities to our view. Within fixed income, choose your risk profile. You're getting 6 to 7% in investment grade credit, probably 7 to 9 in below investment grade credit, and you're getting both at significantly lower volatility than you are in equity asset classes. So we like fixed income versus equities as opposed to the investment grade versus non-investment grade. There's merits to both. It's just a function of your thoughts on the economy and your thoughts on potential volatility and scaling into your investment over time. And again, the reason that all this is good is, the yields are high again. Yields are back to where they were over the, we haven't seen yields like this for 10 years. And it's really goes back to the reset in treasury rates. And the central banks have been trying to generate inflation really for over 10 years. They've finally been successful, and now they're taking away the accommodative policies. And we finally had a 25-year bull market in bonds reverse itself, and it reset treasury rates to levels that we haven't seen in quite some time. And that's made the overall yield in my world look great, look good again. I mean, the yield in our portfolios now is around 8.5%, and the dispersion of yields is anywhere from 6% to 12%, and we can choose our risk tolerance, and we can build out a portfolio that's got moderate risk at very attractive overall yields, and really set up to buffer itself from any type of reasonable volatility that we expect in the markets as we go forward. So really, this reversal in yield is really what's made all the fixed income asset classes on the prior slide look attractive, certainly in and of themselves, but certainly against other asset classes as well. Now, in my portfolios, it's a truly global portfolio. The anchor of the portfolio is the U.S. The U.S. high yield markets are the largest part of the global below investment grade credit space. And it's one of the deeper markets, and it's always going to be the core of the portfolio. But there are other markets that we think look attractive too. The European high yield markets typically are a little bit higher rated than the U.S. high yield markets, a little smaller, a little less liquid, and have historically traded equal to or less yield than U.S. But because of the economic stresses in Europe, the European high yield market's actually cheaper than the U.S. high yield market. There's good reasons for that. That's probably going to be the economy that feels the most recessionary pressures, particularly in the United Kingdom. Brexit's not wearing well. There's a variety of stresses going on there. And that market, we can get 10 to 12% yield in a lot of sterling bonds. But it's a market that looks attractive to us, and it's a market we've been underweight for 5 years. We're still underweighted, but we will take targeted shots there, and it's something where I expect we'll be less underweight as we go forward. Emerging markets on the other side generally does trade cheap to U.S. markets, but it's somewhere that looks kind of interesting now. There's emerging markets. There's basically 3: Latin America, Eastern Europe, and Asia. But Latin America looks like a really good value to us, where we're getting double-B and triple-B securities at spreads that are similar to what we can get in the U.S. in single-B and double-B securities. Eastern Europe, we've been underweight that and will continue to be. Asia, there's not a lot for us to think about in the below investment grade space. It's predominantly an investment grade market. But we've been overweight the China property companies for the better part of a year, and while it's been a little bit of a tough ride from time to time, we are finally starting to see good returns there, and it's an area that we will continue to have risk in the portfolios. But it's truly a global asset class. We like them EM. We're continuing to buy EM. Europe, there'll be a time for it, and the U.S., there's always good opportunities across many sectors. The COVID reopening theme, we continue to have exposure there. We have a decent position in really the lodging leisure, cruise line, airlines, still things that we bought at very cheap levels, secured, meaning that we actually have a hard asset collateral. A lot of these are yielded anywhere from 10 to 12% at the time. They're a little bit inside that now, but still look like good value to us. And so our expectations, we build this out, just the math of where we think total returns could be in a variety of cases. We use this partially as a forecast, but also just as an orientation point. Below investment grade credit is the spread over the treasuries is going to be a proxy to price future default risk. And so when we think about how we think about this, we'll make some basic assumptions on where we think yields will be on the treasury market, as well as do a bottom-up build of what we think a reasonable default assumption will be. Because triple Cs are so much lower, we do think that it's tough for us to envision a moderately slower economic scenario where default rates really get much above 3%. And so in our central case, you can see this. Because the current yield's back and the current yield's high, it buffers a lot of the volatility. But even if we use a 3% default rate assumption, which is double what it is right now, we still come up with a 7 to 8% total return on a forward-looking basis, predominantly through coupon carry. The other thing is, as a fixed income investor, we're always thinking about downside, more so than we are about upside. And the really nice thing is in the downside case, where we get a more, even if we stress the default rate, move it up to 6%, it moves spreads out to 700 basis points over treasuries, which is 250 basis points wider than they are currently. The drawdown is low single digits, 3%. Again, because the yields have reset, because the coupon's so high that buffers a lot of that volatility. And so in a base case, we see high single-digit returns. It's tough for us to get that exercised or that excited about the downside case, and there is potential upside from both of those. So again, going back to why we think it's attractive, why we think it fits into the portfolio, we think it's going to be pretty good in and of itself. I think it's going to look really good against equities. We do expect some spread volatility this year. I would tend to think of credit spreads as being range-bound. As I talked about in our portfolios, we're fine taking some risk in the portfolios. We currently, have about a 0.95 beta, but we want to leave a little bit so that we can add risk later at cheaper levels. We do think we'll get a chance at that. We do think the economy is going to slow a bit, but it's not anything where we think it slows so much that we're really that concerned about default risk. So we really think it's an attractive place to invest. We think it's going to look good versus a variety of other asset classes, and we're coming at it from a position of strength. So again, it's good to see y'all. Hopefully they can translate y'all. I am from Texas. But appreciate your attention and look forward to your questions. Thanks.
投资一定有风险，基金投资有赚有赔，申购前应详阅公开说明书。